In case you have not heard, there's a recession looming if it's not already here. Bitcoin may be in for a wild ride in 2023 as the US stock market and real estate show textbook signs of softening to go much lower as a bear market sets in. And it's not just an American phenomenon. The next recession is likely to be a global one. And you know what comes after recession? Depression. Bitcoin will absolutely be affected by these macro forces, and in this video we are going to explore just how much pain that there could be ahead for all of those of us who refuse to sell our sats. And to make matters worse, the Federal Reserve has launched its testing of the CBDC. They may see this bear market as the perfect opportunity to test out that CBDC and see if it works for a digital dollar. This is an episode that you are not going to want to miss. It is packed to the brim with a lot of information that you are going to be able to utilize to protect your portfolio and potentially gain on your portfolio in the coming months and years. But before we give you all of that alpha, make sure you smash that like button, make sure you hit subscribe, boom, bang on that notification bell. Comment anything that you want in the relevant sections. I appreciate it. Now, let's figure out how you can hedge your wealth and build some generational wealth in the meantime. Now, Bitcoin is in a pretty decent amount of trouble right now. And in my last episode of the series, I issued a warning that probably received a lot of hate. But guess what? I don't really care what the haters think. Go check my comment sections. And the reason is because I've spent years studying a host of global markets, and I trust my instincts because they've got me where I am today. My warning was that those that remain bullish on Bitcoin for the midterm could potentially be foolish. In this episode, I'm going to further support that warning by showing you just how low Bitcoin could go using its historic price movement relative to the price movement of other assets. There are really no better ways to predict future price movement than to look in the past to start. And if you have a contrarian view to anything that I'm saying, I welcome you to share your opposition, but don't be mad at me for offering up my opinion. Just tell me in the comments section. I am simply showing you all the most probable outcomes based on the highest quality research available to me at the time. Now that that's out of the way, let's dive in. All the world's biggest banks like JP Morgan, Goldman Sachs publish data and predictions on where asset prices might be headed in the future. Although they are not always accurate, well, let's be real, most of the time they're not, these predictions often serve as a range of where the market is generally headed. The current guidance from these banks for the S&P's closing price in 2023 is a range from 4,500 to 3,675. Read between the lines. This is a very conservative and wide range by any standards, but it does give us some context. The drawdown potential for the S&P, according to these predictions from prices at the recording of this video, would be about 4.5%. Now, if we assume that Bitcoin would do roughly double that, it's probably going to shed at least about 9% in the same time period. And that price would be close to a $15,000 Bitcoin by the end of 2023. That's actually not too terrible, but we know it doesn't work like that. Because let's be honest, this model is based on very conservative estimates by very conservative firms that are almost never accurate. Now, let's turn to the guidance of some more accurate traders in the market. Gareth Soloway is an analyst that I like because while institutional analysts were saying that Bitcoin was actually headed to about $100,000 in November of 2021, Gareth was predicting a 70% shed all the way down to about 20 grand. Well, he was right, they were wrong. No one wanted to listen to Gareth because he was so bearish. But he is one of the most followed analysts in the entire space. Gareth predicts that the S&P could drop to about 3,000, which would represent a shed of about 22% of today's prices. A 22% shed on Bitcoin would bring us down to about $13,000. And remember what I've been saying since I started my YouTube channel, 10K is in play. Now, that is low and that is painful. But it gets worse. We take a look at the big bank predictions, and when we look at leading analyst predictions, now let's do some macro TA. If you look at the chart of the S&P, you will notice that there was strong support at the $1,500 range that was put in by the highs in the year 2000, and then it was again in the year 2007. In the last two episodes of this series, I showed you how the Fed used their giant bazookas to fight off the recession that ensued after the housing market collapsed in 2008. Well, my conviction is now that the Fed has reversed those bazookas and started pointing them in the opposite direction. There could be a retest of that $1,500 line of support on the S&P 500. And historically, everything gets retested. Even accounting for inflation, it should be about 2,000. But if we retested that, it would be a shed of about 60% on the S&P. But with my more conservative $2,000 S&P estimate, that would represent about a 48% shed on the S&P. Now, if Bitcoin took another 50%, bam, shot to the face, that would literally put it at about 8 grand. But that is only if Bitcoin sheds exactly what the S&P does in the bear market, which we even though, historically speaking, it sheds more. And if we account for that high volatility, drumroll please, at an 80% shed, Bitcoin would be at about $3,000, which is exactly where it ended up and bottomed out when we hit 20K and shed about 85% in the last bear market. Now, I'm sure that you hate to hear that, and so do I. I own a lot of crypto too, remember? But most of my stuff is on the sidelines right now. I've been out since about 38K. This should not be news to those who have been watching my channel for a year. I've been calling 10K Bitcoin for about 12 months. But let's stop beating up Bitcoin because it's not the only asset class that has a correlation with the S&P in bear markets. Real estate is an asset that is tracked by the Census Bureau of the United States. From 2007 to 2009, the median sale of US homes fell by about 19% from $258K to almost $200,000 during the same period that the S&P dropped more than 55%. So real estate does experience less volatility during a bear market recession, but it absolutely feels the pain. And the lines of support don't lie. A correction from real estate down to the same support line, where they put it in the 2007 highs, would have the US homes prices correcting by about 40%. That's pretty substantial, guys. This means a $300,000 home would only be worth about $180K at the bottom of the bear market. So if you can't keep buying Bitcoin or stocks, but you also can't invest in real estate, then you might be wondering, should I just cash out and hold everything in dollars? After all, cash is king, right? Well, let me stop you right there. Forget about it. Absolutely not. Because there are about to be some absolutely major and critical changes coming to our monetary system very soon. There's a pretty good chance that the Federal Reserve has been waiting for this destabilization to happen. If the US economy starts heading into a bear market recession in early 2023 and inflation levels persist, then the Fed will be headed into an impossible dilemma to solve. This dilemma where economic growth measured by GDP is negative at the same time that inflation and unemployment are increasing is called stagflation. Stagflation is historically extremely difficult for governments and monetary policy makers to solve. The US has never faced stagflation while also having a debt to GDP ratio of more than 40%. So this would be a first. Our current debt to GDP ratio is more than 120%, thanks to the out of control government spending and the money printers. So what does the US government do? Well, I think they turn to CBDCs. And if that's the case, they might pull a Nixon and file for bankruptcy. Ironically, the technology that makes Bitcoin so valuable is also a technology that governments could and already are using to put their fiat currency into digital dollars and, more importantly, programmable forms. This is really scary news, and I'm not going to sugarcoat it. I'm going to cover CBDCs and how the US might actually be following in the footsteps of countries like India and China to release their own digital dollar. And you can go and check out my 4-video series on that as well. I will show you how this might affect you and your crypto and even your equities. And I promise you're not going to want to miss this. And then I'm going to show you where you should be putting your money, at least in my opinion. But that's all I've got for this episode. So if you like content like this, make sure that you show up to the next episode. And make sure that you smash that like button. Make sure you hit subscribe, boom, bang on that notification bell. Comment anything that you want in the relevant sections. I appreciate it. Thank you so much for showing up to this video. I will see you in the next one. Have a good day, everyone.